In 2026, the oldest baby boomers are turning 79, the youngest are 61. This is no longer a theoretical conversation about a generation approaching retirement. It is happening in real time, at scale, and the financial picture emerging is significantly harder than the story most people were told about what this generation's retirement would look like. According to the Federal Reserve Survey of Consumer Finances, 43% of Americans between the ages of 55 and 64 have no retirement account at all, no 401k, no IRA, no tax-deferred savings vehicle of any kind. Among those who do have an account, the median balance sits at approximately $185,000. That number might sound substantial in isolation. It is not designed to fund a retirement that could last 25 or 30 years, and according to Bureau of Labor Statistics data, nearly 1 in 5 Americans over the age of 65 is still working. Some choose to. Many do not have a choice. For decades, baby boomers were described as the most financially fortunate generation in modern American history, beneficiaries of post-war growth, rising home values, and expanding markets. As this generation moves fully into retirement age, the actual outcomes look considerably less secure than that narrative suggests. So, what actually happened? Was this overspending and poor planning? Or was something more structural at work, something built into the economic system itself that shaped these outcomes long before any individual decision was made? This is part of our Collapse series. Let's go through it carefully. Part 1. The pension system collapsed and nobody replaced it properly. To understand where boomers are financially in 2026, you have to start with a structural shift that began quietly in the late 1970s and reshaped the entire foundation of American retirement. For most of the post-World War II era, retirement in the United States was built on what economists call a defined benefit model. Large employers promised workers a predictable monthly payment for life. The formula was straightforward. Work for 30 years, retire at 65, receive a guaranteed check every month until you die. Social Security supplemented that income, but for workers at major companies, the pension was the primary pillar of financial security in old age. By the late 1970s, that model began to erode. The Employee Retirement Income Security Act of 1974, known as ERISA, was designed to protect workers after several high-profile pension failures. It increased reporting requirements and funding standards. While protective in intent, it also made pensions substantially more expensive for employers to maintain. Then, almost as a footnote, Section 401 of the tax code was passed in 1978. It allowed employees to defer taxes on income placed into retirement accounts. By the early 1980s, companies recognized the strategic implication. This new structure shifted long-term retirement risk away from corporations and onto individual workers. Under a pension, the employer bore the investment risk. Under a 401k, the employee did. Baby boomers were the first generation to experience this transition at scale. Many began their careers expecting pensions similar to what their parents had received. Instead, they were handed a system that required them to self-direct investments, choose asset allocations, and manage market volatility across decades without the infrastructure that would later make that process more accessible. There was no automatic enrollment, no default target date funds, no low-cost index funds widely available to ordinary investors. Participation rates in early 401k plans were modest, and many workers either undercontributed significantly or cashed out their balances entirely when changing jobs, a decision that felt practical in the moment and proved costly over decades. This was not a minor administrative adjustment to how retirement worked. It was a fundamental reallocation of financial responsibility, moving retirement security from institutions that could pool risk and absorb market volatility to individuals who, in many cases, had never managed an investment portfolio and had no training or support system to help them do so effectively. Part 2. Their first market experience was the worst possible. 1. The standard advice about retirement savings is built around a simple premise. Start early, invest consistently, and allow compound growth to do the work over time. The mathematics behind that advice are sound. But the advice assumes something important: that early market conditions cooperate. For baby boomers entering adulthood in the late 1960s and early 1970s, they did not. Between 1966 and 1982, U.S. equity markets experienced an extended period of weak real returns. Nominal prices moved, but inflation ran persistently high throughout the decade. By 1980, inflation had peaked above 13% annually. When investment returns are adjusted for that level of inflation, long-term investors during that 6-year window saw very limited real growth in purchasing power. In August 1979, Businessweek published a cover story with the headline, "The Death of Equities." That headline captured a genuine national mood. Bonds were offering double-digit yields. Cash felt stable and rational. Confidence in equity investing had collapsed across broad segments of the population. Generational investing behavior tends to be shaped by first impressions, by the market environment people experience when they are first earning money and making financial decisions. Boomers, in their early 22nd during this period, were not stepping into an expanding bull market. They were stepping into stagflation, oil shocks, wage pressure, and repeated market disappointments. For those who invested early, the experience was discouraging. For those who delayed, the hesitation was reasonable given the evidence in front of them. Then, conditions shifted. Beginning in 1982, the United States entered one of the longest bull markets in modern history. From 1982 to 2000, the Dow Jones Industrial Average rose from roughly 800 points to more than 11,000. Inflation fell. Interest rates declined gradually. Equity ownership expanded into mainstream culture, and investing became something ordinary people talked about rather than avoided. But timing matters more than most people acknowledge. By the time this expansion gained momentum, many boomers were already in their 30s and 40s carrying mortgages, raising children, managing career transitions, and operating with the financial constraints that come with midlife. Compounding rewards time more than intensity. A 20-year-old investor has decades to absorb volatility and benefit from exponential growth. A 4-5-year-old managing multiple financial obligations does not operate under the same flexibility. Many boomers entered equities more aggressively later in life, after the earliest and most powerful years of potential compounding had already passed. In theory, they benefited from the strong returns of the 1980s and 1990s. In practice, the window for maximum accumulation was shorter than the narrative of the Great Bull Market suggests. Part 3. 2 market crashes at the worst possible time. By the late 1990s, confidence in equity markets had returned fully. Retirement projections assumed continued growth. Media coverage celebrated the rise of the 401k millionaire. The mood was expansive. Then, the cycle turned sharply. In 2000, the technology bubble burst. The Nasdaq Composite fell nearly 78% from its peak to its trough over the following 2 years. The broader market declined significantly as well. For older baby boomers, many of whom were in their early to mid-50s retirement accounts that had been heavily weighted toward equities after nearly 2 decades of strong returns, were suddenly worth substantially less. Financial planners use the term sequence of returns risk to describe what makes this timing so consequential. Losses early in an investment career can be recovered through time and continued contributions. Losses near retirement are fundamentally different. The portfolio has less time to rebound, and if withdrawals begin before recovery is complete, the damage compounds in ways that simple average return calculations do not capture. Markets began recovering in the mid-2000s. Home values were rising, credit was widely available, household wealth appeared to stabilize, then came 2008. The financial crisis delivered a second major shock in less than a decade. Home prices fell approximately 27% nationally from peak to trough, according to Federal Housing Finance Agency data. The stock market lost roughly half its value between the 2007 high and the 2009 low. Unemployment peaked near 10% in 2009. For baby boomers approaching retirement age, this was not a routine market correction. It was a simultaneous hit to both sides of the household balance sheet, retirement accounts, and home equity declining at the same time, across the same households in the same compressed period. Older boomers were in their early 60s during the crisis. Younger boomers were in their late 40s and early 50s, which are typically peak earning years when financial damage is most consequential for long-term outcomes. Research from the Bureau of Labor Statistics has consistently shown that displaced older workers face longer periods of unemployment and lower reemployment wages than younger workers, meaning job loss during this window carried. Long-term income consequences that compounded over years. Many households reduced equity exposure after the crash, locking in losses and missing a significant portion of the subsequent rebound. The recovery that followed was real and substantial, but it did not erase the sequencing problem for households that were already behind. Baby boomers did not experience a single market downturn late in life. They experienced 2 major asset shocks within an 8-year span, both occurring as they moved toward or into retirement age. And for many, the combination was one from which full recovery was not mathematically available in the time remaining before retirement began. Part 4. Where the numbers stand in 2026. As of 2026, the broad outline of the baby boomer retirement picture is visible in the data. According to the Federal Reserve's most recent survey of consumer finances, 43% of Americans aged 55 to 64 have no retirement account of any kind. That is not a rounding error or a statistical artifact. It means nearly half of the cohort approaching and entering retirement has no dedicated savings vehicle tied to that goal. Among those who do have accounts, the median balance is approximately $185,000. Context matters here. A retirement lasting 25 to 30 years requires sustainable income across decades. Using conservative withdrawal frameworks, a $185,000 to $200,000 portfolio does not generate meaningful annual income without drawing down principal. And for Americans who reach age 65, life expectancy now extends well into the 80s. Debt in retirement has also risen significantly over the past 3 decades. Federal Reserve data shows that a majority of today's retirees carry some form of debt mortgages, auto loans, credit card balances. In earlier generations, entering retirement debt-free was common and widely expected as part of the transition into fixed-income living. Today, it is the exception rather than the rule. This matters because fixed debt obligations do not adjust when income becomes limited and predictable. Home equity is frequently cited as a financial cushion for this generation, and many boomers did benefit meaningfully from long-term appreciation in property values. But home equity is not liquid income without deliberate action. Converting it into cash requires downsizing, cash-out refinancing, or reverse mortgage products, each carrying trade-offs in cost, flexibility, housing stability, and long-term estate planning that make it a more complicated resource than it initially appears. Social Security remains the largest guaranteed income source for most retirees. On average, it replaces roughly 40% of pre-retirement earnings for middle-income workers, a meaningful contribution, but not a complete replacement for working income. The program itself faces long-term financing pressure that is no longer abstract. The Social Security Trustees' 2025 report projects that the Old Age and Survivors Insurance Trust Fund could face depletion in the early part of the next decade without legislative changes. In that scenario, incoming payroll tax revenue would still fund the majority of benefits, but not the full scheduled amount, and the uncertainty itself influences behavior in ways that affect retirement timing and financial planning across millions of households. Some workers claim benefits early, accepting permanently reduced monthly payments because waiting feels financially impossible given current expenses. Others delay to maximize payouts when they can afford to. The decision frequently reflects financial necessity rather than strategic optimization. Meanwhile, labor force participation among Americans 65 and older remains elevated compared to historical norms, with surveys indicating a mix of motivations. Some cite engagement and purpose, others cite financial pressure that makes stopping work not yet viable. The retirement experience in 2026 is fragmented in exactly this way. A segment of boomers holding substantial assets, a larger segment relying primarily on Social Security with limited supplemental savings, and a third group continuing to work because the math does not close without earned income. Part 5. This is not just about personal choices. It is tempting to reduce retirement outcomes to individual behavior. Spend less, invest earlier, contribute more consistently. Those factors matter, and they are not irrelevant to how people end up. But they do not operate in isolation, and attributing the full picture to personal discipline misses the structural forces that shaped outcomes across an entire generation simultaneously. Wage growth for middle-income workers did not keep pace with overall productivity growth over the past 4 decades. While aggregate GDP expanded steadily and the economy generated significant wealth, income gains were distributed unevenly. Higher-earning households captured a disproportionate share of asset growth, particularly during the long equity expansion following 2009. Participation in equity markets is strongly correlated with income level, meaning the households most able to benefit from rising asset prices were also the ones already ahead financially. For middle and lower income workers, the gap between productivity gains and actual take-home pay left less available to save and invest, regardless of individual discipline. Healthcare represents a separate structural pressure that is difficult to plan around. Out-of-pocket medical expenses tend to rise with age, even for individuals covered by Medicare. Supplemental insurance, prescription drug costs, and long-term care needs can materially affect retirement budgets in ways that are difficult to predict with precision years in advance. Longevity adds another layer of complexity. Life expectancy at age 65 now implies that many retirees will live 20 years or more beyond that point. A longer lifespan is a genuinely positive outcome. Financially, it requires a larger asset base, more conservative withdrawal rates, or some combination of both. Underestimating longevity risk, assuming retirement will be shorter than it turns out to be, can result in either depleted savings or a quality of life constrained by excessive financial caution. There is also substantial inequality within the baby boomer generation itself that gets obscured when the conversation focuses on generational averages. Upper-income boomers with continuous labor force participation and consistent equity exposure often accumulated significant wealth across the decades of market expansion. Lower-income boomers, particularly those with intermittent employment, limited access to employer-sponsored retirement plans, or prolonged unemployment during recessions, experienced very different outcomes from the same historical period. The phrase, boomers, retiring broke, is not a universal description. It is a median and lower half phenomenon. The top quartile of the generation holds a large share of total retirement assets. The bottom half holds very little. When retirement risk is individualized rather than pooled through guaranteed income structures, outcomes diverge sharply based on earnings, access, and market timing, and the gap between the top and the bottom of any generation becomes much wider than it would have been under the pension model. Conclusion. The financial situation facing baby boomers in retirement in 2026 is the result of 3 overlapping forces that compounded across decades. The first was structural. The retirement system shifted from guaranteed income to market-dependent individual accounts. Risk moved from institutions to individuals at a moment when most workers had no preparation for managing that risk, And the supporting infrastructure for individual investors did not fully develop for years after the responsibility transferred. The second was timing. A weak inflation-adjusted environment during the formative investment years, followed by two major asset shocks near retirement age, compressed the window for accumulation and limited the opportunity for recovery in ways that average return figures obscure entirely. The third is visible in the numbers that exist right now: median savings insufficient for multi-decade retirements, rising debt carried into retirement, and heavy dependence on a social security program facing its own long-term financing questions. Some baby boomers will retire with substantial security and genuine financial flexibility. That part of the story is real and should not be minimized. But another part of the story, the 43% with no account, the median balance of $185,000, the 1 in 5 still working past 65, reflects outcomes that are financially fragile in ways that the original promise of this system did not anticipate and the design of it did not prevent. Many boomers will manage carefully on limited resources. Others will continue working not because they want to, but because the numbers do not close without earned income. And a portion will rely almost entirely on Social Security for a retirement that could last 2 decades or more. Understanding how this happened matters not to assign blame to a generation or to dismiss the role of individual decisions. It matters because the same system that produced these outcomes for boomers is the system that the generations behind them are currently navigating. The structural design of retirement savings, the relationship between market timing and accumulation, and the gap between what the system promises and what it delivers, those forces did not disappear when boomers aged out of the accumulation phase. They are still operating. And recognizing them clearly is the only way to evaluate whether the outcomes of the next generation will look any different.